We're going to take a look at accounting standards. This is discussed in Chapter 1 of your textbook, amongst other topics, but this is one of the more important topics, so I am making a separate PowerPoint for this particular topic. What is accounting? We've talked about this since day one of Accounting 101. It's a gathering, processing, and communicating financial information about a business to interested users. That might be reworded a different way, such as the identification, measurement, and communication of financial information about economic entities to interested parties. Same thing, okay? So basically, different books might use slightly different definitions about what accounting is all about, but it all comes back down to this. Here it shows about financial statements and reporting. So this is the communication part. And a large part of Accounting 201 and 202 is about financial statements and GAAP and what are all the parts of communicating and interpreting financial statements. So this goes through what we're trying to do at the level of the economic entity, which is the business. We're trying to gather and process and communicate these financial statements is how we communicate. These are our financial statements, our income statement, our statement of owner's equity, our balance sheet, our statement of cash flows. We've done all four of those in Accounting 101 and Accounting 102. We also have note disclosures. Oftentimes, the notes to the financial statements can be a huge number of pages. You have, even in a huge company such as General Motors, you have these four basic financial statements, and then you can have a huge number of notes attached to that, which explains a bunch of stuff that's going on beyond the financial statements. Okay, so GAAP, generally accepted accounting principles, is what dictates how these look, what types of accounts go in, and how we have to do these. Then there's additional information that is given as well. President's letter, reports filed with governmental agencies, forecasts, environmental impact statements, all kinds of additional information, some of which is financial, some of which is not, that goes out to the investors and creditors. Mainly in Accounting 201 and 202, we're worried about this middle section here. Here is where they talk about different things that affect the relationship between stocks and the price that a stock sells for on the New York Stock Exchange or other exchange, and the financial statements and what happens in the company and how that affects the price of stocks. So you may want to read through this on the PowerPoint. In the objectives of financial accounting, this is why. What is it we're trying to get to? Okay, what's the purpose? Okay, so we're providing financial information about the reporting entity, that's the business, that is useful to investors and creditors. Okay, now we said that we're looking to gather, process, and communicate financial information about a business to interested users. Who are those interested users? Well, in Accounting 101, we talked about that. They're investors and creditors and management and governmental agencies. There can also be other stakeholders such as customers, employees, etc., etc. So all of those are interested users, and The financial statements is to help all of those, but primarily the financial statements that are done according to GAAP are primarily for investors and creditors. And even then, if we only had to choose one, it would be investors. This is for public companies, which are companies that have investors that are part of the public. We need to protect the public from fraud and stuff that these companies might be doing. And so the use of GAAP and the requirement for the use of GAAP is primarily to protect the investors, but also to protect creditors. Now, if you have your own business and you go to a bank to get a loan, they're going to require that you follow GAAP. So this is what this PowerPoint is about. How do we get GAAP? Okay. Now, the entity perspective, back in Accounting 101, we said that was when we were looking from the eyes of the business. Okay. The company is viewed as separate and distinct from the owners. We're always looking from the eyes of the business. Okay. We're doing the accounting transactions. We're communicating, processing transactions from the business, not from the eyes of the owner. Okay, decision usefulness. Investors are interested in assessing the company's ability to generate net cash inflows and management's ability to protect and enhance investors' investments. So if the company is able to generate cash and management or the company is able to protect the investor's investment. So in other words, if I pay $35 for one share of General Motors, I'm interested in General Motors' ability, the management of General Motors, to make sure that that price doesn't go down and I lose money. I want that $35 investment price to, at the minimum, stay the same, and preferably to go up so that I have growth and make some money. Okay, so here's, these are various users need financial information, and they're going to get the financial information from these financial statements, and we have to provide GAAP, generally accepted accounting principles, when we're making these financial statements. So who is it that's going to make this GAAP? Well, the accounting profession has, over time, since the 1930s, they've been working on making these standards, and the standards, once they're made, become GAAP. So there's the parties involved in standard setting. There's three organizations. The Securities and Exchange Commission, they are in charge of all public companies. The American Institute of Certified Public Accountants, the AICPA, and the Financial Accounting Standards Board, also known as FASB. Okay, so the SEC, they were established in the 1930s. There was a major stock market crash, the biggest one, 1929, that brought on the Great Depression for 10 years, just far worse than what we experienced over the financial crisis. So at the time, they determined that part of the problem of the stock market crash was that a lot of companies were doing their financial statements however they saw fit, and then all of a sudden they crashed. Okay, so the public who was investing in those companies, thinking they were investing in good companies, and maybe they weren't. Okay, so the SEC was created by the government, and they oversee all public companies to protect the public from another Great Depression. And so they determined that all companies have to follow the same rules. So they're not just doing their accounting however they say fit. We're going to have one set of accounting principles, and all public companies must, by law, follow those. They are also required to have an independent CPA come in and make sure that they're following GAAP in their bookkeeping. Okay? They did encourage the SEC, rather than setting what is GAAP, rather than setting that themselves, they went ahead and encouraged CPAs, a body of CPAs, to set that. And then the SEC could oversee it and they could veto stuff, but they aren't necessarily CPAs themselves that's on the SEC, so they allow the CPAs to set the standards. Then after Enron, which was in the early 2000s, there was Enron and a bunch of other frauds. The SEC felt that the CPAs that were going in and auditing these public companies were not doing the job that they should be doing. Okay, and that helped, even though it was the management of Enron that created the fraud, the CPAs should have caught it. Okay, and so instead they looked the other way. So the SEC set up this PCAOB, and they oversee the CPAs. Okay, so the CPAs used to police themselves and go in and do their own thing, and now the PCAOB oversees, and they come in and check different audits that have been done. The American Institute of CPAs, or known as the AICPA, they are a national professional organization. They are in charge of the CPA exam, and they were in charge of setting GAAP all the way through 1973. There's been various organizations, but they were one of them through 1973. Now, another organization called the Financial Accounting Standards Board, or FASB, is now in charge of setting GAAP. Okay? And so we had these other organizations, the Financial Accounting Foundation, the Financial Accounting Standards Board, and the Financial Accounting Standards Advisory Council. So the Financial Accounting Foundation selects members of the FASB, funds their activities, and exercises general oversight. Then the FASB itself, their mission is to establish and improve the standards of financial accounting and reporting. So they are the ones that actually make GAAP. And the Financial Accounting Standards Advisory Council consults on all major policy issues. So we have these three that together help make GAAP happen. This goes through the process of a standard being created that then becomes part of GAAP. So first of all, topics are identified and placed on the board's agenda. So here's topic A, topic B, and topic C. Okay? Then research and analysis is conducted. Preliminary views of pros and cons are issued. Okay? There's a public hearing on the proposed standards. Okay? Then they go through all what the public thinks, and the board evaluates the research and the public responses, and they issue what's known as an exposure draft, which is kind of an initial standard. Okay? Then that goes, and even more public evaluation of that initial draft, and that comes back, and the board evaluates that and changes whatever they want to change, and then the final standard is issued. Once that's issued, that's it. That's GAAP. From then on, there's no more talking about it, no more changes. And that becomes GAAP, that standard becomes GAAP, and all public companies must then follow it, and CPAs must take that as part of GAAP. Here is where the FASB is trying to put everything together in one place. And so this is an online database where everything, because GAAP has been made by different organizations since the 1930s. The FASB took over in 1973. But even then, there were different kinds of GAAP, and some were considered authoritative. In other words, this is it, and you rely on it. Other stuff would be in the accounting literature that might not be authoritative, or it was only authoritative for a certain case. That kind of thing creates a lot of confusion. So the FASB, in the last maybe 10 years, has been working on this codification, and so that anybody can get on and see exactly what GAAP is. Okay, this talks about how even though FASB has a lot of CPAs and they're doing things in an accounting kind of way, there's a lot of outside influences that affects the FASB and how they do things. So yes, CPAs and accounting firms, the businesses, the public businesses themselves, the financial community such as stockbroker analysts and bankers, etc., preparers of financial statements, government agencies, particularly the SEC, industry associations, the investing public, people from colleges, faculty members, and the AICPA. So all of these have a say in trying to make the FASB do what's best for what they think is best. And so the FASB has to go through all of that. So all of these can influence the FASB. Other financial reporting challenges is that there are things that are not financial in nature, and how do we measure those? Okay, forward-looking information. Most of the public company investors, they want to know what's going to happen in the future. Is the stock price going to go up in the future? That will tell me whether I need to buy it today. Well, obviously, financial statements are about what happened in the past. So trying to have something that can be a little more forward-looking, that will be more, remember we said we wanted things to be useful for the investors. So if we could have things that were more forward-looking, if we could figure out some ways to measure some non-financial soft assets, these are things like copyrights and things, and timeliness. The end of the fiscal year is maybe December 31st. Well, it's the middle of February, maybe end of February, before the financial statements are actually signed off and published to the public. So the public is getting a financial statement that's looking at what happened last year, and they're not even getting it until February of this year. Okay, so timeliness, how can we make things more timely? Because people these days, they want instant information. Understandability. The more complex the financial world gets, the more difficult it is to understand a set of financial statements. This is another issue in setting GAAP, international accounting standards. Now, we have to, the SEC requires us in this country to follow U.S. GAAP. Okay, but there are also international financial reporting standards issued by the IASB. Okay, if we would join in with that, which we have been talking about 25 years. Okay, so if we would join that, there would just be one giant gap for the whole world. Then we could compare financial statements between a US company, a French company, a Japanese company, whatever it was, we could be able to compare them across the world. But right now, most of the world uses these international standards, but we still hang on to our own gap. Now, so internationally, our gap is considered very strong. So for international use, it is allowed, the SEC, at least, if any public company wants to sell its shares on the New York Stock Exchange or another U.S. stock exchange, they're required to either use U.S. GAAP or these international standards. Ethics in accounting is another issue, okay? GAAP doesn't always provide an answer. So it isn't always, so there's GAAP and the GAAP says you should do blah, 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 but your situation is a little bit different, and so how is that affected by GAAP? It's not always a clear answer. And doing the right thing is not always easy or obvious either. So after Enron and other frauds, the SEC set up the PCAOB to oversee CPA audits. Because once again, just like back in 1920s, Enron and some other ones, they found some loopholes. And really, when they got into it, they were not supposed to use those loopholes. They knew they were not supposed to use those loopholes, but they decided not to do the right thing. They decided to protect their company from looking like it was doing really bad, and then everybody would sell their shares, and then they would go bankrupt. So rather than doing that, they used this loophole that really wasn't a loophole for them, but they used it anyways. Okay, and the CPAs looked the other way. And so this happened several times. And so the SEC set up that PCAOB. Now also, if you go to take the CPA exam, there's a whole section now on business ethics. It wasn't there when Dr. Dooley took the CPA exam. Okay? The top management now has to sign off as personally responsible for fraud. Back in the day, the corporation is considered its own entity. So if the corporation itself committed a crime or did fraud, then the corporation could be fined, the SEC could be fined, but the individuals who actually did it, it was very hard to get those Enron top management into jail. So now, ever since then, top management has to sign off to say they're personally responsible for any fraud that happens, that they know that they can go to jail. So that makes it easier for the SEC to get them into prison where they belong. Okay, because once they commit that kind of fraud, that hurts all the public investors and they all lose money. Okay, and so it's not a good thing. Okay, also the SEC required the internal controls, that management put internal controls into place to help prevent fraud and mistakes from happening in the financial place, in the financial statements. Okay. Then they also said that the CPAs have to test those internal controls, make sure they're working, and they have to sign off on those internal controls. okay, that yes, they are in place and yes, they are working. Okay, then finally, the PCAOB might come in and double check so the CPAs know that they